Welcome back to Investing Talk Podcast. Okay, today we're looking at, well, a really dramatic story in semiconductors. Wolfspeed. They've just gone through this massive financial overhaul, right? A complete restructuring. And the market, it's reacting big time. Lots of volatility, shares jumping around quite a bit. So the big question we're tackling for you today is pretty straightforward. Is Wolfspeed actually a buy right now? We're going to analyze the sources, look at this, transformed balance sheet, their tech advantage, which seems pretty solid, and importantly, what's coming up catalyst-wise in the next, say, 90 days. But before we get into all that, quick reminder, please do subscribe, like the show, leave a comment. It really helps us out. Oh, and definitely let us know in the comments if there's another company you want us to analyze next time. We do read those.
It really is an unusual one, isn't it? Almost like hitting a reset button, financially speaking. You've got this company emerging from Chapter 11, perfectly positioned, you could argue, for huge growth in silicon carbide. But at the same time, facing this immediate, pretty intense volatility as everyone figures out the new setup. What's really interesting, though, is that initial price jump, what was it, 48% right after the restructuring?
Yeah, huge move.
That suggests the market isn't seeing this as a failure. It's more like, okay, they did the necessary surgery to save something really valuable here.
Okay, let's unpack that, because this wasn't just shuffling some deck chairs, was it? It sounds like a fundamental reset. What exactly happened in September 2025?
It was, a fundamental reset is a good way to put it. A court-approved plan of reorganization went through. Approved September 8th, they officially exited Chapter 11 on September 29th. And the absolute core benefit, the number you really need to focus on, is that their debt got slashed by about 70%. 70%. That is massive. It just, frees up so much financial breathing room, gives them flexibility they haven't had, removes that existential threat that was hanging over everything.
70% is definitely impressive. But there was a cost, right? For the folks who held the stock before all this went down, it wasn't exactly painless for them.
Oh, no, not at all. We have to be really clear here. The cost was huge dilution for existing shareholders. Basically, the old common stock. Canceled. Gone. Legacy shareholders, the ones who held on through the bankruptcy, they ended up with maybe 3 to 5% of the new company's equity. Just a sliver.
So where did the rest go? Who owns the company now?
Well, the vast majority of the new shares went to the big debt holders. Think major players like Apollo Global Management and even industry names like Renesas Electronics. They converted their debt into ownership.
Right, so now you've got these heavy hitters, financial giants, and a big semiconductor player essentially in control. They're the new owners betting on Wolfspeed's future.
Exactly, and that's the key point, I think. You're looking at a new Wolfspeed now, free from those old crushing debts, yeah? And importantly, backed by these very sophisticated, deep-pocketed owners who clearly see value in the underlying assets and technology.
And the market seems to agree, given that price surge when the new shares started trading in October.
Precisely. That 48% jump wasn't random. It reflects the market saying, okay, the financial structure was the problem, not the core tech. Now that's fixed.
So connecting the dots, it feels like the celebration is about the survival of the technology itself now that it has a stable financial platform.
I think that's exactly right. The confidence isn't just blind hope. It's a recognition that Wolfspeed's expertise, their manufacturing assets, these were worth saving. And now they sit on a much stronger foundation, ready to actually execute on those big growth plans they've been talking about.
Okay, but that strong foundation only matters if the house built on it is solid, right? Which brings us to the technology. Why did Apollo, Renesas, why did they even bother saving this company? It must be the tech.
You nailed it. It's all about silicon carbide. SEX. Wolfspeed is, frankly, dominant in this space. SEX isn't just another semiconductor material. It's, well, almost essential for the next generation of power electronics. It lets devices handle much higher voltages, higher temperatures, faster switching speeds compared to traditional silicon.
Okay, translate that for us. Why should, the average investor care about higher voltages and temperatures?
Because it directly impacts things we all care about. For electric vehicles, it means better efficiency. That translates to, longer range, potentially smaller, lighter batteries, faster charging times. That's huge. And it's not just EVs. It's critical for renewable energy, too, making solar and wind power integration into the grid more efficient and stable. So we're talking about the backbone of electrification, really.
And the growth forecasts for SECR are pretty wild, aren't they? Something like 30% plus SECR through 2030?
Yeah, the projections are very strong, around 30% compound annual growth. And what makes Citi maybe a bit different from some other hype tech is the difficulty in making it, especially at scale. Wolfspeed's big advantage here is their vertical integration. They control the whole process, from actually growing the raw city crystals, the substrate, all the way to making the finished chips, the power devices.
Yeah, that's hard to copy.
Incredibly hard and very, very expensive. By controlling the raw material, they sort of sidestep bottlenecks that competitors face. It creates a really high barrier to entry and gives them, importantly, supply certainty for their big customers, especially in automotive.
Okay, now let's connect that to the financials during the rough patch. Trailing 12-month revenue, around $757 million. But the free cash flow number jumps out negative $2.19 billion. That's a staggering amount of cash burn.
It is, but you absolutely need the context there. That negative $2.19 billion wasn't just, operational losses piling up. It was deliberate, massive capital expenditure. They were spending like crazy to build out future capacity, pouring billions into new fabs, especially that huge cutting-edge 200-millimeter wafer facility in Mohawk Valley.
So the burn was investment.
Exactly. It shows the kind of commitment they had and that their backers had to prioritize building the future production engine over any kind of short-term profit. It was a bet on scale.
And the payoff for that bet, if the analysts are right, looks enormous. Projections showing positive free cash flow, $224 million by 2026, and potentially over $1.2 billion by 2035. That's a U-turn.
It's the classic operating leverage story, isn't it? Once that massive fixed cost, the giant new fab, is up and running efficiently, the cost to produce each extra chip drops significantly. So as they ramp up production, profitability should, in theory, grow exponentially. Plus, they have good visibility on the demand side. They've locked in long-term supply deals with major car companies and suppliers that helps them plan capacity and gives confidence that Mohawk Valley's output won't just sit on the shelf.
All right, let's pivot to the stock price itself. We mentioned the volatility,
Yeah.
the initial 48% surge, then more movement afterwards. Where does the stock stand technically right now after all that shaking out?
Well, the technical chart definitely tells a story of that extreme volatility, but also some emerging stability and bullish momentum now. The stock recently closed around, let's say, $26.17. It hit an intraday high near $28.21 not long ago. But look at the 52-week range from a low of $1.20 during the depths of the restructuring fear up to around $34.28 before the Chapter 11 filing really hit. That gives you a sense of the extremes.
So where's the next hurdle, technically speaking?
The next major resistance level everyone's watching is around that $34 mark. That represents, significant potential upside from current levels, maybe 30% plus.
And where's the floor? Is there a support level forming?
Yes. It looks like solid support has been building in the $24 to $26 zone. It seems like buyers are consistently stepping in around there. So the general outlook, maybe for the next 3 months or so, suggests a trading range potentially between $25 on the low end and maybe up towards $45 on the high end if things go well. Still volatile, but with a clear upward bias for now.
Okay, beyond just the chart patterns, what are the specific dates, the hard catalysts that investors absolutely need to have circled on their calendar this quarter? Things that could really drive the next big move.
Right. The big one, the absolute must-watch event, is October 31st, 2025. That's their Q1 fiscal 2026 earnings release. This is the first official financial report since emerging from bankruptcy. Everyone will be scrutinizing the details of the new capital structure, management's operating plans, and crucially, any updates on how that Mohawk Valley production ramp is actually progressing.
Any delays or hiccups there could be punished pretty severely, I imagine.
Oh, absolutely. The market wants to see execution on that ramp. Then, keep an eye on mid-November, around the 15th, and early December, around the 6th. Those are dates related to institutional ownership reports, the 13F filings, and also potential S&P or EPF index rebalancing.
Why do those matter so much?
The 13Fs will show us which big funds, which hedge funds bought into the new Wolfspeed post-restructuring. That's often seen as the smart money flow. And index rebalancing can force passive funds to buy or sell shares, creating temporary price pressure or support. Adds to the volatility mix. Then, looking a bit further out, January 28th, 2026, that will be the Q2 earnings. That's significant because it'll represent the first full quarter of operations completely outside of Chapter 11.
Okay, anytime you see this kind of potential upside, especially after a bankruptcy, there have to be serious risks too. We talked about the amazing FCF projections, but isn't betting everything on this huge factory ramp-up inherently risky? What are the main headwinds?
You'd like to focus on that. The number one near-term risk is simply execution. Scaling up production at Mohawk Valley is a massive, complex undertaking. Chip manufacturing is notoriously tricky, especially with yields. Six adds layers of complexity. They absolutely have to hit their production targets, maintain quality, keep yields high to meet those big customer contracts. Any significant delays, any problems with equipment, yields, or even getting specialized raw materials that would hit revenue and likely investor confidence hard.
And they're still very heavily tied to the auto sector, right? That
Mhm.
concentration's a risk, too.
It is, yeah. Relying so heavily on the EV market means if EV demand slows down or fluctuates, which we've seen happen, it directly impacts Wolfspeed's orders. That customer concentration is definitely a vulnerability. And one more thing to remember. The dilution. Yes, the balance sheet is clean, which is great, but the number of shares outstanding is much higher now. So the company needs to generate significantly more profit overall just to deliver the same earnings per share that investors look for. The bar for performance is higher.
Beyond those core operational risks, what about rumors? Anything speculative bubbling under the surface that could add some extra juice or maybe risk?
Well, you always get chatter around a company like this with such critical tech and new powerful owners. There's some talk about, maybe strategic moves involving Renesas or Apollo perhaps selling off non-core assets, or maybe even one of them increasing their stake or bringing in other partners. There are also persistent market rumors about Wolfspeed potentially landing another huge supply deal with a major global EV maker, one that hasn't been announced yet. That would obviously be a big positive catalyst if true. And given their manufacturing in the US, there's always background speculation about potential government incentives or grants tied to boosting domestic semiconductor production. That's always kind of floating out there.
Okay, so putting it all together, dominant tech, huge market opportunity, cleaner balance sheet, but significant execution risk and past dilution. How do you synthesize all that into a final take? What's the core investment thesis here?
It's really fascinating. You've gone from this debt-laden company struggling for survival to one that analysts are now rating pretty bullishly, like an 8.5 out of 10 in some cases. The core rationale seems to be what you might call a compelling asymmetric opportunity. What that means is the biggest downside risk bankruptcy, total wipeout that seems to be off the table now thanks to the restructuring, that risk has been mitigated. So shareholders now are primarily exposed to the upside, which, if they execute on the Sikonazi dominance in this massive electrification wave, could be truly substantial. The potential reward now arguably outweighs the mitigated risks, at least in the eyes of the bulls.
That's a clear way to frame it. So just to recap the key takeaways for you listening. Wolfspeed is operating with roughly 70% less debt, holds a commanding position in crucial synchronized technology, has projections for massive free cash flow growth driven by new production capacity, but faces near-term volatility, with the October 31st earnings report being a critical upcoming test.
And if we just zoom out for a final thought, the company's ultimate success really hinges on that global push towards electrification continuing at pace. But given all the talk about potential partners or deals we mentioned, it does raise a really interesting question for the longer term. Will Wolfspeed actually stay independent long enough to fully realize that massive FCF potential on its own? Or, now that its balance sheet is cleaned up and its technology is so critical and vertically integrated, does it just become too tempting an acquisition target for a giant global company, maybe another chip maker, looking to instantly buy its way into CIC leadership? That's something to ponder.
A very interesting question indeed. Something for you to think about as you weigh the opportunity here. Thanks for joining us for this look into Wolfspeed. As always, remember this discussion is just for informational purposes. It's not investment advice. Definitely do your own research. Let us know your thoughts and any companies you want us to cover next in the comments below. We'll see you next time.